Want to invest in the future of technology? Looking for a safe, growing dividend that beats the market? Like the idea of getting your shares on sale after a 25% drubbing? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the biggest tech firms in the world. Close your eyes. Now imagine the society of the future. Is that future society more or less dependent on technology? Is that future society more or less likely to have interconnected devices, aka the Internet of Things? In my opinion, this is a no-brainer, and this company benefits from that almost certain outcome for our future. And that is why it has a long runway for higher revenue, more profit, and a bigger dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Cisco Systems Inc., which appear to be trading at a significant discount today. Cisco Systems Inc., stock ticker CSCO, is a leading designer, manufacturer, and supplier of data networking equipment and software. Founded in 1984, Cisco is now a $196 billion by market cap tech monster employing approximately 83,000 people. The company reports results across 6 groups: secure agile networks, 54% of fiscal year 2022 sales, optimized application experiences, 28%, internet for the future, 11%, collaboration, 7%, end-to-end security, less than 1%, and other products, less than 1%. The investment thesis here is actually very simple in my view. Investing in Cisco is investing in the current and future infrastructure of technology we all use every single day. Without this infrastructure, there is no such thing as, for example, jumping online to use the internet. Cisco is the major supplier of switches, routers, firewalls, and supportive networking products. The various products and services that Cisco sells are critical to network performance and security. That's today, but this is also about tomorrow too, as the internet continues to evolve into the Internet of Things, a ubiquitous interconnection of computing devices into everyday objects. Cisco's products and services will become that much more critical, and that is what paves such a long runway for the company's growth across its revenue, profit, and dividend. As things stand, Cisco has increased its dividend for 12 consecutive years. The 10-year dividend growth rate is 18.3%. That is clearly outstanding. However, it's important to point out that more recent dividend raises have been in the 3% range. I see Cisco's long-term dividend growth path as being somewhere between these two numbers. That belief is partially supported by the moderate payout ratio of 53.9%. This gives the company leeway on the dividend. Meantime, the stock yields a market-beating 3.1%. This yield, by the way, is 20 basis points higher than its own 5-year average. Investors are looking at a nice mix of income and growth here. Speaking of that, I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. Cisco is right in the sweet spot. Looking at business growth, Cisco increased its revenue from $48.6 billion in fiscal year 2013 to $51.6 billion in fiscal year 2022. That's a compound annual growth rate of 0.7%. I usually look for a mid-single-digit top-line growth rate from a mature company like this. and Cisco's lack of more meaningful revenue growth is slightly disappointing. Meanwhile, earnings per share rose from $1.86 to $3.36 adjusted over this period, which is a compound annual growth rate of 6.8%. After looking at Cisco a number of times over the years, boiling it down, it's always struck me as a business that should be good for about 7% bottom line growth rate over the long run. Not excellent, but certainly not bad. Cisco isn't growing as fast as some of the other tech companies out there, but it's been pretty reliable. Consistent and substantial share buybacks have long been part of that narrative, and Cisco did reduce its outstanding share count by 22% over the last 10 years. That definitely helped to create a lot of the excess bottom line growth that we can see here. Looking forward, CFRA anticipates that Cisco will compound its earnings per share at an annual rate of 6% over the next 3 years. This is unsurprising to me. As I just alluded to, it's right in line with what, in my view, Cisco boils down to: a consistent 6% to 7% EPS grower over the long run. CFRA almost perfectly captures the Cisco investment thesis well with this, and I quote, "We continue to believe the long-term prospects for Cisco are positive, including the Wi-Fi 6 upgrade cycle and 5G core deployments. We expect component shortages to be a short-term drag on revenue growth, but we see the issue subsiding early in fiscal year 2023. We see Cisco benefiting from a rapid rise in bandwidth consumption, the high demand for data center solutions, and the migration to cloud networking. Cisco's strong balance sheet will facilitate further M&A activity, share buybacks, and dividend hikes." Unquote. Touching on share buybacks again, which circles back to what I noted earlier, Cisco added $15 billion to its buyback program earlier this year. That amounts to 7.5% of the entire company's market cap. If we assume that Cisco will grow its earnings per share at the 6% to 7% level over the years to come, that should translate to similar dividend growth. That would split the difference between the 10-year demonstrated dividend growth rate and the more recent dividend raises in that 3% range. I think an expectation for Cisco to grow its dividend at somewhere around 7% over the long run would be a reasonable expectation to have. Combining that kind of dividend growth with the 3.1% starting yield makes for a compelling total package. Moving over to the balance sheet, Cisco has a fantastic financial position. The long-term debt to equity ratio is 0.2, while the interest coverage ratio is over 41. Furthermore, total cash laps long-term debt more than twice over. This is a fortress balance sheet. Profitability is undoubtedly robust. Over the last 5 years, the firm has averaged annual net margin of 17.7% and annual return on equity of 22.4%. Cisco isn't super exciting, but boring can be beautiful. There's something inherently attractive about a steady Eddie, dependable business. And with economies of scale, IP, technological know-how, and switching costs, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Cisco must constantly innovate and stay ahead of the tech curve. The company is reliant on enterprise spending, and a broader economic slowdown could impact this spending. Cisco has been acquisitive, with bolt-on acquisitions being a consistent strategy for them, which introduces execution and integration risks. And recent kinks in the global supply chain have been hurting Cisco's ability to deliver products. The risks should be acknowledged, but so should the overall stability and appeal of the business. And after the stock's 25% drop from its 52-week high, the valuation is definitely worth acknowledging. The forward price earnings ratio is only 13.7. That's based on midpoint adjusted EPS guidance for fiscal year 2023. Cisco isn't growing super fast, but this valuation has clearly already priced that in. We are looking at a very undemanding earnings multiple here. Also, the price to cash flow ratio of 4.9 is lower than its own 5-year average of 5.1, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate ties back to what I've been noting all along. Cisco should be good for 7% bottom line and dividend growth over the long run. This number conservatively splits the difference between the 10-year demonstrated dividend growth rate and the size of more recent dividend raises. It's also not far off from Cisco's 10-year earnings per share growth rate or CFRA's near-term EPS growth forecast. I see this as a reasonable long-term expectation, although I would anticipate some modest lumpiness along the way. The dividend discount model analysis gives me a fair value of $54.21. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money. Since $1 tomorrow is not worth the same amment as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Cisco as a 4-star stock with a fair value estimate of $54. CFRE rates Cisco as a 5-star strong buy with a 12-month target price of $60. I think we have a nice consensus here with my number coming in within pennies of where Morningstar is at. Averaging the three numbers out gives us a final valuation of $56.07, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Cisco Systems Inc. is favorably exposed to the technology needs of today, yet it's also poised to benefit from the technology needs of tomorrow. The fortress balance sheet and super consistent results offer a rare level of dependability in the industry. With a market-beating yield, a moderate payout ratio, a double-digit long-term dividend growth rate, more than 10 consecutive years of dividend increases, and the potential that shares are 15% undervalued, dividend growth investors looking for more tech exposure should seriously consider investing in this business right here. And now for a special news announcement. Best Buy Co. Inc., stock ticker BBY, just reported a blowout Q3 report, smashing expectations on both the top line and bottom line. People keep underestimating this retailer, yet Best Buy keeps delivering the goods. Pun intended. After this report, the stock skyrocketed higher. However, based on our last analysis and valuation video, which went live a few months ago, the business still looks cheap compared to our estimate of its intrinsic value at $105.70 per share. Don't be guilty of underestimating Best Buy. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.